Have you ever looked at a company's financial statement and thought, what on earth is this? Income statement, balance sheet, cash flow. It can look like a foreign language. But here's the truth: if you can read a financial statement, you can spot winning investments, build better businesses, and make smarter money moves. And in this video, I'm going to teach you how to read financial statements in just 9 minutes. It's easier than you think, so grab a coffee, and let's decode the language of money together. This is for whether you're an investor, entrepreneur, or just someone who wants to understand how companies really make or lose money. This video is for you. Once you finish watching, you lines know how to open a company's annual report or Yahoo Finance page and instantly tell whether it has a great opportunity or a money pit. Let's break it down into 3 simple parts. The income statement shows how much money a company makes. The balance sheet shows what the company owns and owes. The cash flow statement shows how money actually moves in and out. Part 1, Income Statement. Alright, first up, the income statement, sometimes called the profit and loss statement. This one tells you how much money the company made during a specific period, usually a quarter or a year. Here's the simple formula: revenue, expenses equals profit. Let's break it down. Revenue, sales, the total money the company brings in from selling products or services. Cost of goods sold, COGS, how much it costs to produce those goods or services. Gross profit, revenue minus COGS, it shows how much profit they make before other expenses. Operating expenses, this includes salaries, rent, marketing, and R&D. Operating income, the profit left after paying operating expenses. Net income, the bottom line. This is what the company actually keeps after taxes and interest. Example, let's say a company made $1 million in sales, spent $600,000 producing goods, and had $300,000 in other expenses. That leaves $100,000 in net income. That's your profit, and that's what investors pay attention to. Part 2, Balance sheet. Next up, the balance sheet. Think of this as a snapshot of what the company owns and owes at a single point in time. Here's the formula you need to remember: assets equals liabilities plus equity. Let's break that down. Assets, what the company owns: cash, equipment, property, inventory, etc. Liabilities, what the company owes: loans, accounts payable, or debt. Shareholders' equity, what's left after liabilities are paid, basically the company's net worth. Example, if a company has $10 million in assets, $6 million in liabilities, and $4 million in equity, that's a solid financial position. Investors use this to see if a company is financially healthy or drowning in debt. If liabilities are too high compared to assets, that's a red flag. Part 3, Cash flow statement. Now, let's talk about the cash flow statement, and this one is so important. A company can show profit on paper but still go broke if they run out of cash. This statement tells you how much real money flows in and out. It's divided into 3 sections: operating activities, cash from the core business, sales, expenses, etc. Investing activities, cash spent or earned from investments, like buying or selling equipment or other businesses. Financing activities, cash from borrowing money, issuing stock, or paying dividends. Example, if a company reports positive cash flow from operations, that's a great sign. It means the business is actually generating cash, not just paper profits. On the other hand, if cash flow is negative for several quarters, even if the income statement looks good, that could be a red flag. Bonus: how to read these quickly. Now, here's how you can read a company's financial statements in under 9 minutes. Start with net income. Look at the bottom of the income statement. Is profit growing year over year? Check the debt level. On the balance sheet, compare total debt to total assets. Review cash flow. Make sure operating cash flow is positive. That means the business is healthy. Look for consistency. Strong companies show steady growth, not huge unpredictable swings. Compare ratios. Profit margin equals net income divided by revenue. Debt to equity ratio equals total debt divided by total equity. Current ratio equals current assets divided by current liabilities. You don't need to be a Wall Street analyst. Just understand the basics, and you'll already be ahead of 90% of people. Real-world example. Let's take a simple example. Apple APL. Revenue, $383 billion. Net income, $97 billion, that's roughly a 25% profit margin, which is incredibly strong. Their cash flow is also positive, meaning they can fund operations and still invest in innovation. When you read this, you instantly know Apple isn't just big, it's profitable and efficient. That's what investors look for. Conclusion: why IT matters. Here's the thing. Learning to read financial statements gives you the power to make informed decisions, avoid scams, and spot real opportunities. Whether you want to invest in stocks, start a business, or just understand your employer's health, this skill will serve you for life. And the best part, you can do it without being a math genius. All it takes is a few minutes, some curiosity, and a desire to grow your wealth. If this video helped you understand financial statements better, make sure to hit that like button. It helps more people learn how to take control of their money. And don't forget to subscribe to Artificial Finance Clarity for more simple, powerful videos on money, investing, and wealth building. Because here, we make finance simple and wealth possible.